So we talk about the fundamentals of accountancy for hotel management and culinary arts students. We'll talk about three things: types of accounts, the golden rules, and journal. So you start with, first of all, the types of accounts. So we have personal account and real account and called the nominal account. So what is personal account? What is personal account? Personal account is to do with people basically. Ram's account, Shyam's account, or let's say it could be the name of a company. For example, Tata Limited's account, or Madhav and Shyam Private Limited's account, or Jhunjhunwala and Company account. Yeah, so I mean, because these are also legal people. So when you look at types of personal account, we have natural people, example Vicky, Brian, or Kareem, Sham, and so on. And then you have artificial accounts, which are not really human beings, but in the eyes of law, these are legal entities, right? So we have like Kapadia Private Limited account, or Messrs. Bonds Club account, or it could be any legal entity. You've seen so many companies. And there's a third kind of a personal account also, which is called the representative account. Now, representative means it is not a person in reality, but it is to do with a person. Now, for example, if you look at outstanding interest or outstanding wages or prepaid expenses, all these, or outstanding salaries, all these are what required to be paid to people, right? Therefore, these are taken as representative accounts because they are representative of some person or people. Yeah, so real accounts. Real accounts are the ones which are linked with properties, assets, or positions. Now, what do you mean by properties, assets, or positions? Think of things like furniture, factory, building, plant and machinery, anything which you can see, right? Which are basically what are called assets. Those are all called real account, right? So again, real account can be of two types, which is tangible and intangible. What are tangible real accounts? Tangible real accounts, they have a physical existence. Now, for example, machinery, vehicle, building, all of these, furniture, plant, plant as in we talk about factory over here. All these are tangible real accounts. And intangible real accounts, these don't have any physical existence, but they can be measured in terms of money. For example, goodwill is a good example. Goodwill, you cannot see it, but it actually is a intangible real account. And the third kind of account is nominal account. Nominal account is to do with incomes and gains or expenses and losses. When you purchase something, when you buy something, or when you sell something, when money comes into you through a process like buying or selling, or you make a gain or a loss in a process, or regular expenditure like electricity bill when money is going out, salary, all these are expenses, rent, all these are expenses. So these are all called nominal account. Similarly, if you had a machine which you have sold off, or let's say machine, if you have a, let's say, a property, a land which you have sold off, the land was in the name of the business. When you had purchased, the value of it was, let's say, 50 lakhs. When you sold it off, you got it for 75 lakhs. So 25 lakhs that you got over there is profit over there. So that again, that profit is also a part of nominal account. Now comes in something which is very fundamental to the rules of accountancy. These are called the golden rules of accounting. You have golden rules for personal account: debit the receiver and credit the giver. And then for real account, you have debit what comes in and credit what goes out. And for nominal account, you have debit all expenses and losses and credit all incomes and gains. Debit what comes in, credit what goes out, debit all expenses and losses, credit all incomes and gains. Yeah, these are the three golden rules. You have to remember golden rules. To all transactions which are there in the double entry system of accounting, each transaction is classified as a personal account or a real account or a nominal account, and we will see how this is done through the example of a few journal entries. Now over here you have journal entries which are written over here, a few transactions. So on 1st of April 2020, Anish started a business with 3 lakh capital, and other transactions for the month. So we have purchased furniture, purchased goods, and then again sold goods and withdrawn some cash and paid to a supplier and received from someone a debtor, and again paid salaries. So these are the different kinds of expenses which a particular business, a hypothetical business, has incurred. Now how would these be recorded? The system of recording as per double entry system of accounting is you have journal entries first and ledger entries correspondingly. So the scope of this particular presentation, you'll understand what are journal entries. Now let us look at this transaction over here. On 1st of April 2020, Anish started business with rupees 3 lakh. How would I journalize this entry? So over here we have the format of the journal. You have date when the transaction is happening, as written over here. Date is 1st April, as you can make out, and particulars, which are the accounts which are affected. We shall come back to this shortly. LF stands for ledger folio, as in which page of the ledger would these accounts be reflected in, right? And amount, what is the amount which is debited over here and what is the amount which is credited over here. These are the debit column and the credit column over here. So this particular transaction was journalized as cash account debtor to Anish's capital account. Now observe what happened is Anish started business with 3 lakh. So who received that 3 lakh? The business. The business received the 3 lakh. What came in? Cash came in. Now, cash is an asset over here. It's a real account. So being a real account, debit what comes in. So 3 lakh rupees have come in. Cash account debtor. So these journal entries are all happening in the books of account of the business to Anish's capital account, right? Because Anish is the one who has given it. So there's a personal account over here. So credit the giver, right? We have studied about personal account, debit the receiver, credit the giver. So you have Anish who is the giver over here, and what he has given is the capital to start the business. So to Anish's capital account, which means Anish's capital account has been credited by cash account. That is the other way of looking at it. Cash account is debited to Anish's capital account, or Anish's capital account has been debited by cash account. Both are right ways of saying. And this over here, you see, what happens is once you pass in a journal entry, at some points you may forget why did you put an entry. So this is a pretty simple thing over here. But over a span of months or a few years later, when you look at a particular journal entry, you want to know why was that entry passed. So this is called the narration over here. So this particular line talks about what happened over here actually. So it says being amount brought in to start business. So this is how the narration is made for this particular transaction. And in the second transaction, you have furnitures which were purchased for cash. How much? 27,000 rupees. So now you look over here, although it says purchase, it is not purchase of goods. Goods are, the standard things with which the business is done. So over here, furniture is purchased. Now furniture, as you all know, is an asset. That's a real account, right? And we have cash, so which is 27,000 rupees cash. So which also is an asset. So you have an asset which has come in and an asset which has gone out. Both of this is real account, right? So you have furniture that has come in, so it should be debit the furniture account, right? And which is furniture account debtor to cash account, because credit cash account, credit what goes out over there, both of them being real accounts. So you can see furniture account debtor 27,000 to cash account 27,000 being cash purchase of furniture. Okay, so on 8th of April, goods were purchased for cash 12,000 and for credit 11,000 from Khalil's grocery store. So let's understand what happened over here. The business, I mean, perhaps Anish or maybe one of his employees went to Khalil's grocery store and bought in goods worth rupees 23,000 rupees, 12,000 plus 11,000, goods worth 23,000 rupees. They are purchased from Khalil's grocery store, and these are paid partly in cash. So out of the 23,000 rupees, 12,000 has been paid in cash and 11,000 is on credit actually, right? So how this be reflected? So actually what has happened is you have purchase of goods, a purchase account debtor. Since you have purchase that has happened over here, you see purchase of goods have happened, goods worth how much? Goods worth 23,000. So purchase account debtor, no, that's another again, I would say it becomes a, it's not, no, is purchase a personal account? No. Is it a real account? No. Is it a nominal account? Yes. So purchase is a nominal account. So you have purchase account debtor to cash, right? Why? Because you have cash going out. So how much? A purchase account debtor 23,000 to cash 12,000, and then again credit the giver. You have Khalil's grocery store. So Khalil is the giver over here. It's a personal account over here. You see, it's a legal entry. Khalil's grocery store is a legal entry. So Khalil's grocery store account is also credited. So you have, as you can see, purchase account debtor 23,000 to Khalil's grocery store account to cash account, right? So there is one debit aspect of the transaction, because all in all goods worth rupees 23,000 were purchased and part of it was cash purchase 12,000 rupees and part of it was credit purchase, right? So Khalil's grocery store has given us credit of 11,000 rupees. So we say to Khalil's grocery store account. All right. So actually, when this gets recorded in the journal, it will be the journal entry in purchase account will be purchase account debtor to Khalil's grocery store account 11,000 to cash account 12,000. But Khalil's grocery account will be credited by purchase account 11,000 only, and again cash account will also be credited by purchase account 12,000 only. So here on 14th of April we have a new transaction. We have sales happening, sold goods. So you have a sales account, that's a nominal account. So goods sales is always a income, so it is to be credited, right? And so you have goods are sold to Khanna Brothers. Now Khanna Brothers have picked up goods worth rupees 12,000, and also we have cash sales separate for 15,000. So when it says Khanna Brothers rupees 12,000, because it does not mention anything, it means it is credit, because or else they would have said rupees 12,000 cash, but when they have not said, it means 12,000 is credit sales which are happening to Khanna Brothers, and this is separate cash sales, and that doesn't matter who has bought it for cash, 15,000 rupees, because what matters for us is that cash has come to us. And so the journal entry would be Khanna Brothers account debtor. Why debtor? Because debit the receiver. Khanna Brother has received. Now this is a legal entity over here. Khanna Brothers account debtor 12,000, right? Again, cash has also come in. You have 15,000 cash which has come in, right? So that is an asset which has come in. That's a personal account. Debit the receiver. Cash, debit what comes in. So 15,000 has come in. to nominal account to sales account, which is over here. So credit all incomes and gains. So you have sales which is happening over here. The sales of 27,000 which is happening altogether, of which 12,000 is from Khanna Brothers and 15,000 is cash. Right? So you have, what are the types of account here? You have all three. You have personal account, you have a real account, and you have a nominal account. April 18th transaction, the owner withdrew rupees 20,000 for personal use. Since there is cash which is withdrawn, which means cash is going out. So credit what goes out, it's an asset. So cash account is credited and owner is Anish. Anish is taking off, part of his capital. He had put in 3 lakh rupees as capital. Now he's taking off 20,000. So Anish's capital account debtor to cash account should be the particular transaction for this. Similarly, if you have paid Khalil grocery store rupees 5,000. So we had picked up some goods from here. I think it was worth about 12,000 perhaps, but that doesn't matter. So right now we have paid how much? 5,000. So what has gone out? Cash, right? How much has gone out? 5,000 has gone out. So if 5,000 is gone out, so cash account, is it to be debited or credited? Credit what goes out. So to cash account it has to be. And debit the receiver. Who has received the money? Khalil's grocery store has received the money. So Khalil's grocery store account debtor to cash account. That is what the transaction will be. As you can see, for this we have Anish who had withdrawn the capital of 20,000. We have Anish's capital account debtor 20,000 to cash account 20,000 being part withdrawal of capital, and Khalil's grocery account debtor 5,000 to cash account being part payment made. So 5,000 was not the total amount of goods that we had taken from him. It might have been 12,000 or so. So we right now have paid off 5,000 of it. So to cash account. Now let's look at these two entries over here. On April 26th, we received rupees 10,000 from Khanna Brothers. Well, they had picked up, I think, goods from us and paid salaries expense of rupees 20,000. So when we have received 10,000, it means cash has come in. Yeah. So debit what comes in, it's a real account over here. Cash account debtor 10,000, and who has paid it? Credit the giver. So Khanna Brothers are the giver to Khanna Brothers account. So cash account debtor 10,000 to Khanna Brothers account 10,000. Paid salaries. Salaries are an expense. What has gone out? Cash has gone out. So debit all incomes and expenses. Again a nominal account over here. So you have salaries account debtor 20,000 to cash account 20,000. Right? So these are your transactions over here. Cash account debtor 10,000 because they have received 10,000 from Khanna Brothers to Khanna Brothers because they credit the giver being amount received from Khanna Brothers. That's a narration over here. April 30th, you have salaries which were paid. How much? 20,000. So what has gone out? Cash has gone out. So credit what goes out to cash account 20,000 and debit all expenses. That's a nominal account over here. Cash is a real account over here. The salaries account debtor. Salaries is an expense, nominal account. Debit all expenses and losses. So that's an expense over here. Salaries account debtor 20,000 to, it's a real account. Credit what goes out. So you have to cash account 20,000. These are the overall journal entries of all the transactions that we have done over here, starting receiving of the capital till paying of the salaries, which was the last transaction. You may want to pause the video at this point and have a look at the overall journal transactions that have happened over here. Here, these are the sites which I have been through to make this particular video, and I'm thankful to them.